Have you been collecting Social Security for years and simply trusting that the amount deposited into your bank account is correct? What if that number is wrong? What if you've been underpaid every single month without even realizing it? And what if the mistake has already cost you thousands of dollars? If you were born before 1955, today's video could be one of the most important retirement videos you ever watch. Because right now, millions of Americans are relying on Social Security to cover basic living expenses. For many retirees, Social Security isn't just extra income, it's the foundation of their entire retirement budget. It pays for groceries, it helps cover utility bills, it helps pay property taxes, it helps buy medications. And for some retirees, it's the difference between financial security and financial stress. That's why even a small mistake in your benefit calculation can have a major impact on your retirement. Today, we're going to uncover why some retirees are receiving less than they earned, how Social Security determines your monthly payment, why people born before 1955 may be especially vulnerable to these issues, and the exact steps you can take to protect yourself. Make sure you stay until the end, because one simple review of your earnings record could potentially increase your monthly income for the rest of your life. Let's start with a basic question. How does Social Security decide how much money you receive every month? Many people assume it's based on the last job they worked. Others believe it's based on how much they paid in taxes during their final years of employment. But neither of those assumptions is correct. The Social Security Administration uses a formula based on your lifetime earnings history. Specifically, they look at your highest earning years throughout your working career. Every paycheck you earned, every employer who reported wages, every year that taxes were deducted from your income. All of that information becomes part of your permanent earnings record. The system then uses that record to calculate your retirement benefit. At first glance, that sounds straightforward. But here's the problem. The calculation is only as accurate as the information inside the record, and that's where many retirees run into trouble. Imagine working for decades. You spend years building a career. You work overtime. You earn promotions. You pay Social Security taxes every payday. Then years later, when it's finally time to collect benefits, some of those earnings are missing from your record. Suddenly, the government believes you earned less than you actually did. And because it thinks you earned less, it pays you less. Month after month, year after year. Most people never notice. Why? Because very few retirees have ever reviewed their complete earnings history. Many simply assume the government has everything correct. Unfortunately, that's not always the case. Social Security records stretch back decades. For people born before 1955, some earnings records date back 50 years or more. Think about how much has changed since then. Paper records, manual data entry, employer reporting systems, computer migrations, database updates, millions upon millions of records being processed every year. Mistakes can happen, and when they do, the consequences can last a lifetime. Financial experts often point out that even a single missing year can reduce retirement benefits, especially if that missing year was one of your highest earning years. Let's look at an example. Suppose you earned a strong salary during a particular year in the 1980s. Maybe you received bonuses. Maybe you worked significant overtime. Maybe it was one of the best income years of your career. Now imagine that year appears incorrectly in your Social Security record. Instead of showing your actual earnings, it shows a much lower amount. Or worse, it shows zero. When Social Security calculates your retirement benefit, it doesn't know the information is wrong, it simply uses what's in the system. The result is a lower monthly payment, and because Social Security benefits continue for the rest of your life, that error keeps affecting you every single month. At first, the difference may not seem dramatic. Maybe it's $50, maybe $75, maybe $100. But retirement isn't measured in months. It's measured in years. A retiree who loses $100 per month loses $1,200 per year. Over 10 years, that's $12,000. Over 20 years, that's $24,000. And that's before considering annual cost of living adjustments. Suddenly, a small error becomes a very expensive mistake. Now let's discuss another issue that affects many Americans born before 1955. Retirement timing. Many people became eligible for Social Security at age 62 and immediately claimed benefits. At the time, it felt like the right decision. Some needed income. Others faced health concerns. Some worried that Social Security might run out of money in the future, and many simply wanted access to benefits as soon as possible. What they didn't fully understand was how early claiming could permanently reduce monthly payments. For individuals whose full retirement age was 66, claiming at 62 could significantly reduce benefits, and that reduction doesn't disappear later. It stays with you every month, for life. Many retirees only learned the true impact years afterward. They realized their checks were smaller than expected. They compared their benefits with friends. They spoke with financial advisors. And they discovered that waiting longer could have produced substantially higher monthly income. Now let's be clear, claiming early is not always wrong. For some retirees, it was absolutely the correct choice. Every situation is different. The problem is that many people never received a full explanation of the long-term consequences. They made decisions without understanding the numbers. And unfortunately, once benefits have been collected for years, some options become much more limited. Another area where retirees frequently lose money involves earnings records that were never checked. Think about your own work history. Can you remember every employer you've had? Every job, every paycheck, every tax document? Most people can't. And that's perfectly normal. But because people don't remember every detail, they rarely verify that those details appear correctly in government records. That's exactly why mistakes can remain hidden for decades. Someone may retire at age 66, begin receiving benefits, continue receiving those benefits for 10 years, and only then discover that one or more earning years were recorded incorrectly. By that point, thousands of dollars may already have been lost. The shocking reality is that many retirees never discover these errors at all. They simply assume everything is accurate, and because they never check, the problem continues indefinitely. This is one reason financial professionals encourage retirees to review their earnings records regularly. Not because mistakes are guaranteed, but because mistakes are possible. And when the stakes involve your retirement income, verification matters. In a moment, we're going to discuss the specific warning signs that could indicate your Social Security record contains errors, along with the exact documents you should gather if you suspect a problem exists. We're also going to explain why some retirees have successfully increased their monthly benefits after reviewing their records and what steps you can take if you believe you're being underpaid. But first, understand this. No one cares more about your retirement income than you do. Not your former employer. Not a government computer system. Not an agency representative. You have the strongest incentive to ensure every dollar you've earned is properly accounted for, and that simple mindset could end up protecting thousands of dollars that belong to you. Now let's continue with the most important question. How do you know if your Social Security benefit might be wrong? The answer starts with your earnings history. Most retirees have never looked at their complete Social Security earnings record. They assume that because taxes were taken from their paychecks, everything was automatically recorded correctly. But assumptions can be expensive. One of the biggest warning signs is finding years that show unusually low earnings. For example, imagine you worked full-time during a particular year. You remember having a stable job. You remember receiving regular paychecks. Yet your Social Security record shows only a few $1,000s in earnings. That should immediately raise questions. Another warning sign is a year showing zero earnings, even though you know you were employed. These situations are more common than many people realize. Sometimes an employer reported information incorrectly. Sometimes records were lost. Sometimes data entry mistakes occurred. And sometimes discrepancies simply went unnoticed for decades. The important thing is not to panic. Instead, focus on verification. Start by reviewing each year carefully. Look for anything that doesn't seem right. Ask yourself simple questions. Was I working during this year? Did I earn more than what's shown? Does this amount seem unusually low compared to surrounding years? Even small discrepancies deserve attention, because small discrepancies can lead to meaningful reductions in retirement benefits. The next step is gathering documentation. This is where many retirees become discouraged. They assume they no longer have old records, but you'd be surprised how much information can still be located. Old tax returns, W-2 forms, pay stubs, employment records, pension statements, payroll summaries, even archived financial documents can help support a correction request. The more evidence you can provide, the easier it becomes to demonstrate that your earnings history contains errors. Many retirees are shocked when they discover boxes of old documents in storage that suddenly become valuable decades later. That's why experts often recommend keeping employment records whenever possible. You never know when they might become important. Now let's talk about another issue that affects thousands of retirees. Many people assume Social Security automatically informs beneficiaries when mistakes are discovered. Unfortunately, that's not always how the system works. The Social Security Administration processes enormous amounts of information every year. Millions of beneficiaries, millions of earnings records, millions of monthly payments. While employees work hard to maintain accuracy, no large system is perfect. Errors can remain hidden unless someone actively investigates them. And that's why personal responsibility is so important. Waiting for someone else to identify a problem may not be enough. In many situations, the person who ultimately discovers the mistake is the retiree. That discovery often begins with a simple review of an earnings record. Now imagine this scenario. A retiree notices a missing year from the early 1980s. After gathering documents and contacting Social Security, the record is corrected. The correction increases monthly benefits by $80. That may not sound life-changing at first, but over 10 years, that's nearly $10,000. Over 15 years, it's more than $14,000. Over 20 years, it approaches $20,000. And that's before considering annual benefit increases. Suddenly, a simple correction becomes extremely valuable. This is why financial experts often describe Social Security reviews as one of the highest return activities retirees can perform. A small amount of effort today can potentially produce benefits for years into the future. Let's discuss another common misunderstanding. Many retirees believe that once benefits begin, their payment amount is permanently locked forever. In reality, certain circumstances can trigger recalculations. Corrected earnings records can affect benefit amounts. Additional earnings can sometimes affect calculations. Changes involving spouse benefits may affect calculations. Survivor benefits can affect calculations. The rules are complicated, but the key point is simple. Never assume nothing can change. If new information becomes available, it's worth exploring your options. Now let's talk about spouses. Many married couples focus only on their own work history. What they don't realize is that spouse-related benefits can sometimes provide additional income. The rules surrounding spousal benefits are complex. Eligibility depends on several factors. Age matters. Claiming decisions matter. Work history matters. Marriage history matters. Because the rules are complicated, many retirees never fully explore all available options. The same issue applies to survivor benefits. When a spouse passes away, surviving family members are often overwhelmed by emotional and financial challenges. Important benefit decisions may be made during a very stressful period. Years later, some individuals discover they qualified for options they never understood. Again, nobody intentionally hides this information. The challenge is simply that the Social Security system is extremely complicated. That's why education matters. The more you understand, the better equipped you are to protect your retirement income. Now let's address a question many viewers may be asking. What if everything is correct? What if you review your record and find no mistakes? That's actually great news, because you'll gain something equally valuable: confidence, peace of mind, certainty. You'll know that your earnings history is accurate. You'll know your benefits were calculated properly. You'll know you're receiving what you've earned. That's a worthwhile outcome too. Remember, the goal isn't to find mistakes. The goal is to verify accuracy. If everything checks out, you've eliminated uncertainty. If something is wrong, you've identified an opportunity to fix it. Either way, you win. Let's summarize the action steps every retiree should take. First, create or access your Social Security account. Second, review your earnings history year by year. Third, identify any years that appear inaccurate. Fourth, gather documentation supporting corrections. Fifth, contact Social Security if discrepancies exist. Sixth, follow up and keep records of all communications. Seventh, remain patient and persistent throughout the process. These steps may sound simple. That's because they are. But simple actions often produce powerful results. The biggest mistake retirees make is doing nothing. They assume everything must be correct. They postpone checking their records. They tell themselves they'll review it later. Then later becomes next month. Next month becomes next year, and years pass without action. Don't let that happen. A review that takes less than an hour could potentially uncover money you've earned through decades of hard work. Money intended to support your retirement. Money that belongs to you. For Americans born before 1955, this message is especially important. Many of your earnings records stretch back several decades. Many were created long before modern digital systems existed. That doesn't mean errors definitely exist, but it does mean verification is worth the effort. After all, you spent a lifetime working. You earned those benefits. You paid into the system. You followed the rules, and you deserve every dollar you've earned. So don't rely on assumptions. Don't rely on guesswork. And don't assume someone else has already checked everything for you. Take control. Review your record. Verify your earnings. Protect your retirement income. Because even a small correction today could make a meaningful difference for years to come. If you found this information helpful, be sure to leave a comment below and share this video with friends, family members, neighbors, and fellow retirees. You never know who might discover a costly mistake hiding in their Social Security record. And helping someone uncover money they've earned could be one of the most valuable favors you ever do. Thank you for watching. Stay informed, stay proactive, and most importantly, make sure you're receiving every dollar you've worked so hard to earn.